December 10, 2008. A penthouse apartment on the Upper East Side of Manhattan. Bernie Madoff sits across from his two sons. He is calm. They are not. He speaks 4 sentences that end a $65 billion lie. There is no investment strategy. The returns are fake. It's all just one big lie. It's basically a giant Ponzi scheme. His sons leave the apartment and call the FBI. 18 hours later, their father opens his door in pajamas and surrenders to federal agents. The largest financial fraud in human history is over. Bernie Madoff ran 2 businesses from the same building. The legitimate one occupied the 19th floor of the Lipstick Building in Midtown Manhattan. Bright lights, modern terminals, young traders executing real transactions for real clients. This was the window dressing. The real operation was 2 floors below. The 17th floor was dark. The windows were covered with blinds, boxes were stacked against walls. An ancient IBM AS400 computer hummed in the corner. This machine, obsolete by a decade, printed the fake account statements that convinced thousands of investors they were getting rich. They were not getting rich. They were being robbed. The fraud began in the early 1990s. Madoff's legitimate trading business had suffered losses. He could not accept failure. He could not tolerate being seen as anything less than the genius his clients believed him to be. So he started making up numbers. The first fake returns were small. Corrections to cover temporary shortfalls. He would make it right later. He always told himself he would make it right later. He never did. The scheme was elegant in its simplicity. New investors gave Madoff money believing he was investing it in stocks using a sophisticated strategy he called split-strike conversion. The strategy sounded complex. It was completely fictional. Madoff never bought any stocks. He deposited the money in a Chase Manhattan bank account. When existing investors wanted withdrawals, he paid them from the same account using money from newer investors. The returns on their statements were invented. The profits existed only on paper. The system worked as long as more money flowed in than flowed out. For 17 years it worked. The 17th floor operated like a counterfeiting operation. Frank DePascali ran the machinery. He was Madoff's chief financial officer, a rough-edged guy from Queens who spoke in profanity and operated with complete loyalty. DePascali and his team created fake trade confirmations for transactions that never occurred. They backdated records. They manufactured documentation for audits. When regulators or clients requested proof of trades, DePascali's team printed thousands of pages of fabricated records on dot matrix printers so old that the paper came out hot. They stored the freshly printed stacks in refrigerators to cool them down before handing them to auditors. The fraud was that crude. The oversight was that absent. The account statements showed a perfect line. Year after year, Madoff's fund returned 10 to 12%. Never a losing month. Never a significant drawdown. When the S&P 500 dropped 10%, Madoff was up 1%. When markets crashed, Madoff was steady. The graph of his returns was a 45-degree angle drawn with a ruler. No legitimate investment in history produces such results. The consistency was not a sign of genius. It was a sign of fabrication. And almost no one noticed. Harry Markopolos noticed. He was a quantitative analyst at a competing firm in Boston. His bosses asked him to reverse engineer Madoff's strategy so they could replicate it. Markopolos tried. The math did not work. He ran the numbers again. They still did not work. He ran the numbers again. He examined Madoff's claimed trades against actual market data. Madoff reported buying General Motors stock at $45.10 on a day when the stock never traded above $44.90. The trade was impossible. The entire strategy was impossible. The entire strategy was impossible. Markopolos became obsessed. He compiled a dossier titled "The World's Largest Hedge Fund is a Fraud." He submitted it to the Securities and Exchange Commission in 2000. The SEC did nothing. He submitted an expanded version in 2001. Nothing. He submitted again in 2005, this time with 29 specific red flags proving that Madoff could not possibly be generating legitimate returns. The SEC opened a cursory investigation, interviewed Madoff, and closed the case. They never verified a single trade. They never called the clearinghouses to confirm that Madoff's reported transactions had actually occurred. 5 minutes of due diligence would have exposed the fraud. The call was never made. Markopolos grew paranoid. He believed Madoff must be connected to organized crime. How else could such an obvious fraud continue unchallenged? He started carrying a gun. He checked under his car for bombs. He warned his family that he might be killed. He described himself as the boy who cried wolf. The wolf was real. No one would listen. Madoff cultivated an image of exclusivity. He did not advertise. He did not solicit. He turned potential investors away. This created the perception that getting into his fund was a privilege. Wealthy individuals begged for access. They referred friends and family. They felt lucky to be included. The psychology was deliberate. People who feel fortunate do not ask hard questions. They do not want to jeopardize their special status. They trust the person who made them feel chosen. The money came through feeder funds. These were investment vehicles managed by third parties who collected capital from clients and funneled it to Madoff. Fairfield Greenwich Group was the largest. They charged fees for directing money into Madoff's fund. They performed no meaningful due diligence. They were paid not to look. When clients asked about strategy or risk management, the feeder funds provided reassuring answers based on nothing. They collected hundreds of millions in fees for turning a faucet and never checking whether the sink was draining. The client list read like a social register of wealth and philanthropy. Steven Spielberg, Kevin Bacon, Elie Wiesel, major universities, charitable foundations, Jewish community organizations that Madoff cultivated with particular care. Hadassah, the Women's Zionist organization, lost over $90 million. Yeshiva University lost over $100 million. The Chayes Family Foundation, which funded Jewish education globally, lost everything and shut down. Madoff had positioned himself as the trusted steward of his community's wealth. He destroyed the safety net for thousands of the most vulnerable people his community served. The returns on paper were staggering. Clients believed they were worth billions. They lived accordingly. They donated to charities based on their phantom wealth. They pledged gifts to hospitals. They supported museums. They made financial plans for their children and grandchildren built on foundations of ink and lies. Of the $65 billion that Madoff claimed to manage, only about $20 billion was actual principal that investors had deposited. The other $45 billion existed only on statements. It was money that had never existed, created by typing numbers into an obsolete computer on a dark floor of a Manhattan office building. The fraud required continuous feeding. As long as new money exceeded redemptions, the scheme survived. The financial crisis of 2008 ended that balance. Markets collapsed. Investors panicked. People who had felt secure with Madoff suddenly needed liquidity. Redemption requests flooded in. By early December, clients had requested $7 billion in withdrawals. Madoff checked the Chase account. It held $234 million. The gap was impossible to bridge. The math had finally broken. December 9, 2008, Madoff told his brother Peter, who served as the firm's chief compliance officer, that he was finished. He announced that employee bonuses would be paid immediately rather than in January. $173 million went out the door to staff and family. This was not generosity. This was looting. The building was burning, and Madoff was grabbing what he could carry on the way out. December 10, 2008. Madoff sat his sons Mark and Andrew down in his penthouse apartment. The room was filled with expensive art. The lighting was warm. The news was cold. He explained that the investment advisory business was a fraud. Everything they thought they knew about their father's success was false. Their children's trust funds were worthless. Their reputations were destroyed. Their entire lives had been built on a crime. Mark and Andrew Madoff went directly to their lawyers. The lawyers called the FBI. The sons did not warn their father. They did not give him time to flee or destroy evidence. They turned him in within hours of learning the truth. December 11, 2008, 8:30 a.m. FBI agent Theodore Cassiope knocked on the door of Madoff's apartment. Madoff answered in his pajamas. He did not resist. He did not feign surprise. "There is no innocent explanation," he said. He offered to go down to the office to discuss it. He was arrested on the spot. The investigation revealed the full scale of the destruction: $65 billion in claimed assets, approximately $20 billion in actual losses, thousands of victims across 40 countries, entire fortunes erased, retirements vaporized, charities shuttered. The ripple effects touched people who had never heard Madoff's name, beneficiaries of organizations that could no longer fund their missions. The human toll was measured in more than dollars. At least 3 victims committed suicide. One investor shot himself in the head at his desk. Another drove to his country club and did the same. A French aristocrat who had invested family wealth spanning generations slit his wrists after learning it was gone. Mark Madoff, Bernie's older son, hanged himself on the 2nd anniversary of his father's arrest. He left behind a 2-year-old child sleeping in the next room. Frank DePascali cooperated with prosecutors. He explained the mechanics of the fraud in detail. He identified co-conspirators. He died of lung cancer in 2015 before he could be sentenced. Other employees went to prison. Peter Madoff, the brother, received 10 years. The accountant who certified the fake records received 6 years. The sentencing judge called the scheme extraordinarily evil. Bernie Madoff pleaded guilty to 11 federal felonies in March 2009. He expressed what he called remorse. Victims in the courtroom did not believe him. They testified about destroyed marriages, ruined health, children who could not afford college, elderly parents who lost their care. One victim told Madoff that his own father had committed suicide after the fraud was exposed. Madoff sat expressionless. The judge sentenced him to 150 years in federal prison, the maximum possible. It was a symbolic number designed to ensure he would die behind bars. He did. Bernie Madoff died in a federal medical facility in North Carolina on April 14, 2021. He was 82 years old. He had served approximately 12 years of his sentence. He never provided a full accounting of where all the money went. He never named everyone who helped him. He took secrets to his grave. The recovery effort continues. A court-appointed trustee named Irving Pekar has spent over a decade clawing back funds from investors who withdrew more than they deposited. These were not criminals. They were victims who happened to cash out before the collapse. Their gains came from money stolen from later investors. The legal fights have been brutal. Pekar has recovered approximately $14 billion. Victims have received portions of their lost principal. They will never receive the fictional profits they believed they had earned. The SEC faced intense criticism for failing to catch the fraud despite explicit warnings. An internal investigation found that the agency had received credible tips about Madoff at least 6 times over 16 years. Investigators had never verified a single trade. They had taken Madoff at his word. They had been intimidated by his reputation and his connections. They had failed at the most basic level of their mission. The regulators who missed the fraud kept their jobs. Some received promotions. The system that allowed Madoff to operate for decades was examined in congressional hearings that produced reports and recommendations. Some procedures changed. The fundamental incentives did not. The next fraud is being planned somewhere right now, by someone who watched Madoff's success and learned not to get caught. $65 billion. 150 years. At least 3 suicides directly attributed to the fraud, likely more that were never counted. A man who positioned himself as a pillar of his community revealed as its greatest destroyer. The largest Ponzi scheme in history, operated from a dark floor of an office building, documented on an obsolete computer, hidden in plain sight for 2 decades while regulators looked everywhere except at the obvious truth. Madoff claimed the strategy was too complex to explain. The strategy did not exist. Madoff claimed he acted alone. He had dozens of accomplices. Madoff claimed he never intended for it to go so far. The fraud expanded every year for 17 years. The lies continued until the money ran out. The only thing that stopped Bernie Madoff was arithmetic. When the withdrawals exceeded the deposits, the curtain fell. The wizard was just a man in pajamas waiting for the knock on the door. Roll. You are an elite YouTube documentary scriptwriter, like Magnates Media or Cold Fusion. Your goal is 100% viewer retention. You hate fluff. You cut boring parts. You write for speed and visual impact.